How do I use index funds for asset allocation? Are you wondering how to effectively use index funds for asset allocation in your retirement planning? You are not alone. Many self-employed individuals seek to create a solid financial strategy for their future. Let's break it down step by step. First, asset allocation is about dividing your investments among different asset classes. This typically includes stocks, bonds, and cash. The goal is to balance growth potential with risk based on your retirement timeline and income needs. To start, choose index funds that representing different asset classes. For growth, stock index funds are ideal. These funds track broad market indexes, such as total domestic stocks or international stocks. You might also consider a total world stock index for a global approach. For income and stability, bond index funds are a great option. These funds track bond markets and help reduce volatility in your portfolio. Additionally, having cash or cash equivalent funds can provide liquidity for short-term needs. Next, determine your target allocation based on your retirement stage and comfort with risk. If you are in early retirement or approaching it, you might want a higher allocation to stocks, like 60% stocks, 35% bonds, and 5% cash. This approach can help guard against outliving your savings by allowing for growth. As you move into mid to late retirement, gradually shift toward more bonds and cash. For instance, at ages 70 to 79, you might aim for 40% stocks, 50% bonds, and 10% cash. By age 80 and beyond, consider a mix of 20% stocks, 50% bonds, and 30% cash. A simple and balanced portfolio structure can be effective. One popular strategy is the three-fund portfolio. This includes a domestic total stock market index fund, an international stock index fund, and a total bond market index fund. This approach provides broad diversification across different asset types while keeping costs low and management easy. Implementing a bucket strategy can also help manage your income and growth needs. Divide your portfolio into buckets based on when you will need the money. For example, a short-term bucket with cash or short-duration bonds can cover 6 months to 2 years of living expenses. A medium-term bucket with bonds can cover expenses for 8 to 10 years. Finally, a long-term bucket with stocks and some higher-risk bonds can be set aside for growth beyond 10 years. Withdraw income from the short-term bucket while allowing the long-term bucket to grow. Lastly, remember to rebalance your portfolio periodically. Over time, market movements will shift your allocations away from your targets. Regularly sell some of the overperforming assets and buy underperforming ones to maintain your desired allocation. Consider using tax-advantaged accounts like individual retirement accounts or 401(k) plans to hold these index funds. These accounts can defer or eliminate taxes on dividends and capital gains, helping your portfolio grow more efficiently. By using index funds for asset allocation, you can create a diversified, low-cost portfolio tailored to your income needs and risk tolerance. This strategy can help manage risk while providing growth potential to support a sustainable retirement income.